Hi, thanks for joining us at Bloom Accounting. Today I have Ivan Chen with us. Thank you so much for being here.
Oh, happy to be here.
He is from Rise Above Finance, and he's a certified financial planner, a chartered life underwriter, and many more credentials, which our video team will happily put it at the bottom for you. Bottom line is he is very experienced and knowledgeable. I thought today would be wonderful to have him here to speak specifically about life insurance. In light of the pandemic we're going through, I think people are thinking about life and death and estate planning. So why, as a business owner, life insurance is important?
Let's kind of take it into two aspects of it. Let's focus on the group where we're focusing is the corporation first, right? If the corporation is gonna have an issue, if someone that is a key person passes away, it's gonna really affect the company. So imagine if someone that is the main revenue earner and he got sick because of critical illness. How do you think that would actually affect the corporation when most of the revenues are gone, right? So having these type of insurance in place, or even let's just say life insurance or critical illness in place, when someone is either diagnosed with a critical illness, the insurance company will provide a lump sum to the corporation itself. Now the corporation has a lot of options on what they can do, right? And they can either say, I'm gonna use some of this money to help you recover, or they can say, okay, we are gonna lose X amount of revenue, at least we're covered while he's not able to work. It gives them more options. Or now we can also hire someone in the interim if we need to replace his position, right? And the life insurance aspect, we can look at it as usually creditors will be pretty panicking if a key person is gone. They're going to be concerned, great, are they going to default anytime soon, right? So sometimes when they panic like that, they will actually call a loan, right? So if you have, imagine a $3 million loan to operate your company, and then they see that the key person that generates the income is gone, are we going to lose the money? Okay, let's call this loan to protect our own benefits, right? So these are some of the real reasons why the key man insurance is really important in the areas of protecting the company.
So it ensures the survival of the company move forward with its services and products and its sales, and it doesn't die when, unfortunately, the key man has passed away. The company itself, its employees, all its assets, intellectual property, if any, all goes on. From a tax perspective, you mentioned a couple aspects there. Insurance itself is usually, insurance premiums itself are normally not tax deductible, but if the company had a loan and the policy is used as collateral for the loan to generate property or business income, then it is a tax deductible expense.
Yes, that's true, right? So we want to be able to utilize some of these life insurance, but a lot of the time, what you want to do is to make sure you worked hard to actually build your company. Like, it's not an easy task. Like, it takes a lot of sweat equity, a lot of time away from family. And then you have all these employees that's dependent on you, right? So if one thing was to happen and you don't have the insurance in place, all of that could go away within months. So imagine letting everyone go, or you're not able to sustain, there's no revenue coming in. So definitely, even though it's not tax deductible, having the money come in, because you're not writing it off, the death benefit is still tax-free to the corporation, right? So there's a lot more flexibility that way.
Right, so having enough time in this video, I'd love to talk about the structure of that. So the beneficiary would be the company, the owner would also be the company, the insured would be the key man.
Yes.
Is that correct? Yeah.
Right, so in the case of, let's just say if a shareholder was the company owner within the corporation, we have to be careful in two aspects, right? Are we insuring them for the purpose of estate planning, or are we insuring them for the purpose of just covering for these type of mishaps? So when we're looking at the mishaps part, we want to keep it more within like a term insurance type of aspect of things. And keep the costs low. We can cover a lot more and be able to be more sustainable. Plus, if we actually look into a whole life with participating dividends payout, then these type of dividends could be subject to creditors in the future, right? And is also going to throw the CCPC calculation off if it's less than 90% actually going back to the value of the company. We want to be careful with that. Mm-hmm. So whenever we're talking about, okay, what type of insurance has to be held either with the corporation or the holding company, that's a discussion they should technically have with an insurance advisor or their accountant.
Or both together.
Mm-hmm.
Right. Well, thank you so much for watching. We will be doing another video on capital dividend accounts. This ties in with insurance as well, and you'll hear more about it later.